Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalyst talk. Today, we're looking at strategy.
If you find our talks useful, please consider subscribe, like, and comment underneath. And just a quick note before we jump in today, we use StockOracle to help structure our analysis.
Right, which is an AI-aided stock research platform.
Yeah, but we need to be super clear here for everyone listening. This is not financial advice.
Definitely not.
It's not a trading signal service, and it's not real-time market data. AI insights and valuation estimates can be incomplete or, just straight up wrong sometimes.
Yeah, so you always need to verify the important facts yourself.
Exactly. But if you want to check it out, there is a special 14-day trial link below in the description. It is an affiliate link, meaning the channel may earn a commission at no extra cost to you.
Right.
Okay, with that out of the way, let's get into the wealth-building context for today's analysis. Imagine a company with a profit margin of negative 2,400%.
Which is just, it's a wild number to even say out loud.
It really is. I mean, by all traditional rules of capitalism, this business should be dead and buried. The doors should be completely padlocked.
Oh, absolutely.
But instead, it is the largest publicly traded corporate holder of Bitcoin on the planet.
It completely defies standard financial logic.
Yeah.
I mean, we're looking at a diagnostic landscape of just absolute extremes today. Strategy is a legacy software company that has essentially hacked corporate treasury management.
Right.
And in doing so, they've created one of the most polarizing financial profiles on the entire market.
And the stakes for understanding this profile are just incredibly high for you listening right now, because Strategy is currently trading around a 78% discount from its 52-week high.
A massive haircut.
Huge. So our goal today is to figure out what that discount actually represents. Are we looking at a terrifying value trap where the underlying math is just finally catching up with them? Or, is this a contrarian high-leverage opportunity of a lifetime?
Well, to figure that out, we really have to look past the superficial numbers and examine the actual mechanisms driving them.
Right.
We need to look at the fundamentals, unpack how they're trying to build an operational moat, and then look at the technical catalysts that could, potentially trigger a reversal.
Let's start with that fundamental paradox, then, because I still cannot get over that negative 2,400% margin.
It's definitely jarring.
But before we get to the massive loss, we should probably establish what their actual day-to-day business looks like. Strategy is, at its core, an enterprise software company.
Correct.
And the data shows a gross margin of 68.11%.
Which tells us their legacy product is still highly relevant. They maintain strong pricing power in a really competitive software sector. Their top-line revenue growth is about 6.79%. So it's not hyper-growth, but it is a reliable cash-flowing business.
Okay, so a steady, maybe slightly boring software company.
Right.
But then you look further down the income statement and hit that net margin, negative 2,482%. Honestly, how does a company's stock not immediately go to zero when they print a number like that?
Because that terrifying negative number isn't actually a reflection of cash leaving the building.
Okay.
Their software business isn't suddenly hemorrhaging money. The negative margin is entirely driven by how accounting rules force them to report the value of their massive Bitcoin holdings.
Ah, okay.
It all comes down to something called non-cash impairment charges.
Right. I saw that term in the data, but how does an impairment charge actually drag a margin down into the thousands of negative percentages?
It has to do with how standard accounting principles, the GAAP rules, historically treated digital assets. They were classified as indefinite-lived intangible assets.
Which is a mouthful.
It is, but functionally,
Okay,
let's say Strategy buys a block of Bitcoin at $60,000.
Okay.
If the price drops to $50,000 for even an hour during the financial quarter,
Just an hour.
just an hour. The accounting rules say the company has to record that drop as a massive financial loss or an impairment on their income statement.
So even if the price bounces back to $65,000 the very next day, they still have to report the loss.
That is the crucial quirk in the system. They have to report the loss if it dips, but they are generally not allowed to record the gain when it goes up.
Unless they sell it.
Exactly. Unless they actually sell the asset. So you have this bizarre situation where their balance sheet reflects all the downside volatility of Bitcoin, but none of the upside.
Wow.
It makes their net margin look like a complete financial apocalypse, even though their actual bank accounts are fine. Their software business continues to generate real, positive free cash flow.
And they desperately need that free cash flow, right?
Okay.
Because they haven't just been passively buying a few tokens with their spare change.
No, not at all.
They've been accumulating a staggering amount of Bitcoin, and they are using debt to do it. The data mentions they heavily utilize convertible debt structures. How does that actually work here?
Well, convertible debt is basically a hybrid financing tool. Essentially, Strategy borrows hundreds of millions of dollars from institutional investors to buy more Bitcoin.
Okay.
But instead of just paying those investors back with high cash interest payments, which would, drain their software profits completely, they offer the lenders a choice.
Right.
If Strategy's stock price skyrockets, the lenders can convert that debt into company shares.
Oh, I see. So the lenders are willing to accept a lower interest rate on the loan because they're getting a sort of lottery ticket attached to it.
Exactly.
If the stock moons, they get equity instead of just getting their cash back.
That is the trade-off. It allows the company to borrow massive sums of money without crippling their immediate cash flow, but it introduces the risk of diluting their existing shareholders if all that debt eventually turns into new stock.
I'm trying to picture the sheer scale of this risk for regular people. It's like, okay, it's like a guy who owns a reliable, steady little corner store.
Okay, I like that.
It sells milk, it sells bread, it brings in a predictable profit. But the owner goes to the bank, points to his reliable store, and takes out millions in loans against it just so he can buy highly volatile modern art and stack it in the back room.
It goes even further than that, actually, because he's continuously going back to the bank, taking out more loans against the store to buy more art.
Right.
He's banking on the idea that the art will appreciate faster than the interest on all those loans.
And if the art market completely crashes, the bank is going to come and take the corner store.
Which brings us directly to the bear case and why the stock is down 70% right now.
Right.
The loudest critics in the market are waving massive red flags because that reliance on Bitcoin, layered with that convertible debt, creates extreme vulnerability to volatility.
So let's talk about those risks. The most significant risk highlighted in the data is the raw price action of Bitcoin itself. Financial analyst Peter Schiff is cited with a very stark warning here. He points out that if Bitcoin breaks below the $50,000 support level, it could trigger a rapid decline down to the $20,000 or $30,000 range.
A huge drop.
Yeah. If that happens, how does that actually threaten the company's survival? Don't they just, hold the asset and wait for it to recover?
Well, they could wait if they had bought it with cash. But remember the bank loans in your corner store analogy.
Right, the debt.
When they borrow money, those loans come with debt covenants. These are specific financial conditions they legally agree to maintain.
Okay.
If the value of the underlying asset backing the company, the Bitcoin loses half its value, the lenders get incredibly nervous. The financial ratios required by those covenants could come under intense strain.
So the lenders could potentially force them to sell the Bitcoin at the absolute bottom of the market just to cover the debt.
That is the ultimate nightmare scenario for the bulls. But the bear case isn't just about Bitcoin crashing. It's also a comparative argument about their core software business.
How so?
The market is looking at strategy and holding it up against the explosion of growth in artificial intelligence. The analysis highlights AI companies like Nebius, which has grown its revenue 33-fold in just 8 quarters.
33 times larger in 2 years.
Exactly.
And Strategy is sitting there at a 6.8% growth rate. But honestly, isn't that a completely unfair comparison?
It seems like it, yeah.
Like, Nebius is a pure-play, hyper-growth AI company trying to invent the future of computing. Strategy is executing a highly specific treasury strategy. They're playing 2 entirely different games.
You're right that the business models are apples and oranges. However, capital markets are fiercely competitive.
Sure.
Investment funds have to decide where to allocate their capital for the absolute best return. Right now, hypergrowth AI is incredibly attractive.
Yeah, everybody wants in on AI.
So when a portfolio manager looks at a 6% growth rate in a legacy software firm, it looks anemic. Regardless of the Bitcoin treasury strategy happening in the background, it is an opportunity cost argument.
So investors are basically saying, why would I risk my money on a complex Bitcoin debt strategy when I could just buy an AI stock that's doubling every few months?
That is exactly the sentiment dragging the stock down. But we have to ask if that negativity is already fully baked into the current price.
Right.
Because the stock is trading at a deep discount, specifically a price-to-book ratio of just 0.70.
Okay, let's ground that term for a second. A price-to-book ratio of 0.70 functionally means what for you as an investor?
It means that if you took all of Strategy's assets, including their massive Bitcoin stash and their software business, and subtracted all their debt, the theoretical liquidation value is higher than what the stock market is currently pricing the company at.
Oh,
Yeah,
yeah.
you're essentially paying 70 cents to buy a dollar's worth of underlying assets.
Which implies that the market has completely priced in the worst-case scenario. Investors are just assuming the stagnation and the debt risks are going to destroy value.
Pretty much.
But if that much pessimism is already priced in, it makes me wonder what happens if they actually pull this off. Our data suggests they're doing a lot more than just passively hoarding digital tokens and hoping the line goes up.
Right. They are actively trying to construct an operational moat around their treasury strategy.
Yeah.
They recognize they have a massive first-mover advantage as the largest corporate holder, but they want to translate that into becoming the foundational infrastructure of digital finance.
Which is a huge pivot. For example, they recently joined the Bitcoin Security Consortium. And they aren't just sitting at the table with a bunch of anonymous crypto startups, right? They are partnering with massive traditional institutions like BlackRock and Coinbase.
It's a massive signal of institutional credibility. They are committing to a $15 million research and development fund aimed specifically at defending the Bitcoin network against quantum computing threats.
Which is fascinating because quantum computing, the idea of supercomputers becoming so powerful they can just crack standard encryption, is often cited as the ultimate existential threat to the blockchain.
Yes, exactly.
So Strategy is actively funding the armor to protect their own investment and, by extension, the entire global ecosystem.
They are transitioning from being a passive passenger on the network to an active defender and builder. And it extends far beyond just security research, too. They recently unveiled a new Bitcoin banking index.
Right. The analysis mentions unconfirmed rumors that they might use this index as a foundation to launch institutional custody solutions or even yield-generating products.
Think about the implications of that. Instead of just holding Bitcoin and dealing with the massive impairment charges, they could start charging massive institutions a fee to securely custody their digital assets.
Using the security frameworks they're building right now.
Exactly. It would create high-margin, recurring revenue streams entirely independent of their legacy software business.
That completely changes my corner store analogy. Like, they aren't just the guy hoarding art in the back room anymore.
No, not at all.
They are building the highest-tech art vault in the world, designing the security systems, and creating the standard measuring scales for the whole town to use. They are trying to become the infrastructure that Wall Street actually relies on.
That captures the pivot perfectly. They want to be the foundational layer, and there's evidence that the traditional financial world is engaging with them.
Right.
Michael Saylor, the architect of this strategy, recently noted that Strategy is currently the largest position in 3 major ETFs.
So even if retail investors are terrified of the volatility, massive institutional funds actually want exposure to this specific strategy.
It creates deep network effects. Once a major institution starts relying on Strategy's indexing or security frameworks, the switching costs become incredibly high. They become entrenched.
Okay, but if this infrastructure pivot is really taking shape behind the scenes, why is the stock still sitting at $91.67?
Good question.
If the thesis is so strong, why hasn't the market caught on? Let's look at the technicals and what catalysts might actually turn this massive ship around.
Well, the technical setup right now is really defined by exhaustion. We mentioned the stock is deeply disconnected from its 52-week high of nearly $420.
Right.
The multi-week returns are severely negative. But the internal data shows a volume regime of 0.74x.
Okay, let's translate that volume regime for someone who doesn't stare at trading terminals all day. What is the baseline here?
Think of 1.0 as the normal average daily traffic of buyers and sellers for this specific stock. A volume regime of 0.74 means the trading floor is clearing out. The volume of shares changing hands has dropped significantly below average.
So the intense selling pressure that drove the price from 420 all the way down to 91 is just running out of steam.
Exactly.
The people who wanted to panic sell have already hit the button.
That is the theory behind a capitulation bottom. When you combine that shrinking volume of sellers with a price-to-book ratio below 1, it suggests the downside risk might be structurally limited at these levels.
Right.
There just isn't enough selling pressure left to push it much lower relative to the raw value of the assets they hold.
And this bottoming process is happening just as we approach some very specific catalysts. We have their next quarterly earnings report coming up in late October or early November 2026.
And the market is going to scrutinize that report for two specific things. First, any signs of revenue stabilization in the legacy software business, just to ensure the core cash flow engine is still running.
Yeah, that makes sense.
Second, any updates on how they are navigating those brutal impairment accounting rules. Perhaps they'll provide alternative non-GAAP metrics to show their true financial position.
Outside of the company's control, though, there are major macroeconomic shifts on the horizon, right? We're looking at an environment of potential interest rate cuts. Historically, cheaper borrowing costs act as a massive tailwind for risk-on assets like Bitcoin.
Absolutely. When money is cheap, capital flows out of safe haven bonds and searches for higher returns in riskier assets. But the sentiment around Bitcoin itself is also undergoing a structural shift among major institutions.
How so?
The analysis cites a note from Galaxy Research stating that Bitcoin's risk-reward profile is improving over the next 6 to 12 months. They actually categorize Bitcoin as a Veblen good.
I know a Veblen good usually refers to something like a designer handbag or a luxury watch or product where demand paradoxically increases as the price goes up because the high price signals status.
Right.
But how does that apply to a digital currency? Are institutions buying it just to show off?
It's not about status, it's about institutional liquidity mechanics.
Okay.
Massive entities like trillion-dollar pension funds or sovereign wealth funds have strict rules about what they can invest in. They literally cannot buy into an asset class if the total market cap is too small.
Why not?
Because their massive buy orders would completely distort the price, and they wouldn't be able to sell when they needed to without crashing the market.
Oh, I see. So the higher the price of Bitcoin goes, the larger its total market cap becomes. And as it gets bigger, it actually becomes a safer, more liquid sandbox for the mega funds to play in.
Exactly the mechanism. The high price itself creates the liquidity required for institutional adoption. As the price rises, and as ETF inflows continue to strengthen the market, it forces larger and larger institutions to finally enter the space.
Wow.
Demand increases precisely because the price went up.
It's the ultimate institutional fear of missing out, driven by their own structural rules. But, before we get entirely swept up in the bullish infrastructure narrative, I want to look at what the people inside the building are doing.
That's always important.
Because the data shows net selling from insiders over the last 90 days. If the stock is at a capitulation bottom, why is management selling?
The insider activity definitely requires some nuance here. Yes, the overall net volume of shares traded by insiders leans towards selling, which, often happens for tax purposes or scheduled compensation packages.
Sure.
But the composition of the trades is what really matters. Despite the net negative volume, there have been 51 individual buy transactions over that same period.
Oh, okay. So a few executives might be cashing out large blocks, but a significant number of individuals inside the management team are looking at the $91 price tag, reaching into their own personal bank accounts, and buying the stock.
It signals that a wide swath of the management team still sees immense value, and they're willing to put their own skin in the game at these discounted levels.
There is one final technical metric I want to highlight because I think it brings all of this back to reality for the average listener. The stock has a beta of 3.574.
That's a huge number.
For context, the broader market, like the S&P 500, has a baseline beta of 1. What does a beta of 3.5 actually mean for someone holding this in their portfolio?
It means that if the broader market goes up 1%, strategy might violently swing up 3.5%.
Okay.
And if the market drops 1%, this stock could plummet nearly 4%. It is exceptionally volatile.
Right.
So even if we're at a capitulation bottom, it doesn't mean the ride gets smooth. It just means the roller coaster might be starting its next massive swing from a lower baseline.
So we are looking at a company trading at a massive discount, actively building the foundational security and indexing infrastructure for a new financial system, with insiders buying the dip, but it is permanently strapped to one of the most volatile asset classes on the planet.
That sums it up perfectly.
Let's synthesize this. What is the final verdict derived from our analysis today?
Synthesizing all of it, the technicals, the fundamentals, and the operational pivot strategy earns a 6 out of 10 bullish score.
A 6 out of 10. Okay, so the analysis leans positive, but it heavily acknowledges the immense structural risks involved.
Yes. It is defined as a high beta contrarian opportunity. Because it's trading at such a deep discount to its net asset value, It offers the potential for a massive mean reversion rally. But, and this is key, this thesis is not for a short-term swing trade.
You have to be strapped in for the long haul.
The data is clear that this requires a multi-year horizon.
Yeah.
The long-term view is tied to the Bitcoin halving cycles and the gradual structural integration of digital assets into the traditional financial system. You are betting on the infrastructure actually taking hold.
It's just a deeply complex story. We started by looking at a company with a negative 2,400% profit margin, assuming the financial engine was completely blown.
Right.
But when you look at the mechanics, the gap accounting rules, the convertible debt, the institutional liquidity requirements, it turns out the engine isn't broken. It's just a completely new kind of corporate machine that the traditional market hasn't figured out how to price yet.
It really is a hybrid entity operating in a transitional phase of global finance.
Which leaves us with a final, lingering question for you to mull over. If strategy successfully pulls off this incredibly audacious pivot, if they actually manage to transform from a legacy software company that just holds volatile tokens on its balance sheet into a high-fee, critical infrastructure powerhouse for the digital economy.
The ripple effects would be staggering.
Exactly. Will the traditional tech giants, the Apples, the Microsofts, the Googles, be forced to adopt similar treasury-to-infrastructure playbooks just to survive the next decade of finance?
It's entirely possible.
Because if holding massive piles of cash becomes a liability due to inflation and controlling digital infrastructure becomes the gold standard, the little corner store leveraging itself to buy modern art might just turn out to be the smartest museum in the world.
It's definitely something to watch.
Absolutely. Well, that wraps up our look at strategy today. Again, the final verdict is a 6 out of 10 bullish score with a multi-year long-term view.
Don't forget to like, subscribe, and drop a comment below with your thoughts.
And as a reminder, we use StockOracle for our research, which is an AI-aided platform. It is not financial advice, trading signals, or real-time data, and AI can definitely be wrong sometimes. But if you want to try it out, that 14-day trial affiliate link is in the description below. Thanks for listening, and we'll see you next time on Smart Wealth with Joshua.